Bitcoin is going parabolic. It almost looks like another bubble. It almost looks like this has to burst. But when we look at on-chain data, that might not be the case. In the end, we usually see a bubble bursting when the first cautious people are selling, and we don't see that selling yet. The fundamental cause of this price appreciation is not a lot of retail investors, a lot of nervous capital entering. Instead, it's long-term holders. It's Wall Street. It's also the Bitcoin treasury companies. In aggregate, those entities tend to stack sats long-term, and they tend to not really sell. Have a look at the Bitcoin ETF flows in the last days. So this chart starts in the middle of April, and on almost every single day we have seen inflows. So Wall Street buying up Bitcoin. Yes, there are a few days of outflows, but in the end the trend is clear. This is how the balance then looks like over time. We hit one all-time high after the next. The Bitcoin that's freely floating around, that's available for trading, tends to shrink further and further. So here's the Bitcoin price development together with the ETF balance. But on top of that, we've also got the Bitcoin treasury companies. For example, Michael Saylor with MicroStrategy. In the last 1.5 years, they bought more than 1 million Bitcoin, or more than 5% of the entire supply. And it seems like over the year, this trend tends to rather accelerate, despite the price going up, right? What we see at the bottom is the balance measured in Bitcoin, not in US dollars. So the demand by those entities is growing faster than the price. Thus, it's unlikely that we're going to see suddenly a turnaround. Rather the opposite, a further acceleration of the rally. Chances are, when you're watching this video, that you're a retail investor and that you don't manage a multi-billion-dollar fund. That in turn means you're part of the minority that tends to win in investments, right? The majority tends to lose. Profit concentrates in the hands of a few people. And what we see over here is the number of addresses with more than one Bitcoin. This is not growing in the last 2 years anymore. The Bitcoin price clearly did grow from 16K to above 100K, but this was not driven by retail. The number of the quote-unquote small wallets is not going up anymore. Also, the number of searches for the term Bitcoin is not going up. So again, it's not the masses that push up the price. It's a few players with a lot of money that buy Bitcoin regularly and that don't sell in aggregate. I really like how this chart tends to go up almost monotonically. There are just a few dips overall, but in the end, the trend is clear. But that then begs the question, right? At what point in time might it make sense to potentially sell at least some Bitcoin? When could the market potentially be heated? When will first players take profit? There are several indicators that used to work quite well in the past. So there's the realized hodl ratio. This shows how much short-term trading happens relative to long-term holding. When this is very high, the market is heated, a lot of short-term money is in the market, and then we might turn around. When this is low, it makes sense to buy heavily, right? This is when only the long-term holders are in and nobody else trades Bitcoin. Currently, we are somewhat balanced, so we are not yet heated in this metric. Here's the market value to realized value Z-score. So this looks at how high is the current price relative to the realized price, relative to the average cost basis. Again, when we're going up very, very quickly, this tends to peak, and we are not yet near the peak. Here's the hodl waves. So this shows how much of Bitcoin is held by the wallets that have moved it within the last 6 months. So when this is high, again, a lot of short-term speculative money is in the market. When this is low, the long-term holders tend to hold more of Bitcoin. And currently, we tend to be rather on the lower end again. Now, why would we ever sell Bitcoin? Why would we ever change the hardest of the monies that might even shrink in circulating supply if we deduct, say, the lost Bitcoin? Why would we ever sell this for something that inflates over time, say the US dollar, right? That expands with its supply by roughly 6.8% every single year. The only real answer is risk management. If you don't want to go down in your net worth by 60, 70, 80% over the course of 1 or 2 years, if you want to reduce that volatility, if you don't want to stomach that volatility, then it does make sense to also own other asset classes. So say stocks or precious metals or property or just high yield cash. Because let's say your net worth is 10 years of your annual income. So let's say per year you make 100K US dollars, your net worth is $1 million. would you really feel comfortable having all of that money in crypto? Because let's say you are at the 10 years, you have saved for this for decades, maybe you save for this for 10 or 20 years. Will you, in that case, be okay to go down with that wealth by 85%? So you move from 10 years to 1.5 years. Or afterwards here, this was a drop of 80%, you go from 10 years to 2 years. Anybody that has some kind of significant money in the markets comes to the conclusion at some point that diversification is not the worst of all things. Yes, we might lose a little bit of expected value, so the long-term growth of our wealth might not be as steep, but potentially that doesn't matter even that much, because if we have, say, 20 years of net worth, right? 20 years of income in net worth, or if we've got 30 years, that doesn't matter that much compared to whether or not we have 10 years versus just 2 years. So that gap is much more important. That's because of the marginal utility of money, right? Our first $1,000 are super important to us. Once we have $100,000, having then $101,000 isn't that important anymore. So growth becomes less and less important, and wealth preservation becomes more important. We don't want to crash down that much anymore. Thus, when we time the market right and we buy Bitcoin low, and then it grows massively, and it grows maybe from 10% of our net worth to 50% of our net worth. In that case, even though we might expect the price still to continue to go up, it might still make sense to sell at least some of the Bitcoin, maybe restoring it back to 10% of net worth. And then the big question is, what are good times to exit the market? Where do we have a potential opportunity to at least somehow pick the top? And one of my favorite indicators for that is the value days destroyed. Now, I'm not going to go into the details of the indicator, but basically what this is measuring is what is the dormant Bitcoin doing. So the Bitcoin that hasn't moved for a lot of years, the Bitcoin and the wallets that have a lot of Bitcoin, right? The whales that tend to just be diamond hands. When they suddenly start moving their Bitcoin to potentially sell it, that's the time when I want to exit as well, right? When the diamond hands are convinced that Bitcoin's price is high enough to sell, maybe it makes sense to somewhat copy trade that. And so the indicator is not perfect, right? It does not necessarily flash red at the exact tippy top every time. It flashed red at 40K, and then Bitcoin went up to another 60K to then subsequently crashed. It's also signaled red at 72K, then we went down to 52K, and now we are back up again. So it's simply just an indicator to potentially have medium-term exit opportunities to rebalance the portfolio. Currently, we are not in the red zone, so that suggests that the rally could continue further. At least the long-term diamond hands are not selling. There's also the long-term holder supply change. So this is now the wallets that have held Bitcoin for at least half a year, and they tended to sell the temporary tops. They tended to then buy again the temporary bottom. They sold again here at the top, and they actually bought last time the top as well. They didn't sell over here. Currently, they might start selling slightly, but again, it's not as low compared to when Bitcoin topped out in the past. So really, this rally looks quite healthy. We are always selling Bitcoin only to mitigate risk. And the risk is to get closer to the average cost basis of the market, right? At the end of a bear market, we tend to go below the realized price. So this is when the market as a whole is in losses and the current price is below the orange line. People tend to give up. That's obviously a very good time to buy. And that's a potential risk that we're always facing. Long term, the realized price tends to go up. And currently it is at 50K. A bit below that. So that's a potential risk that we are currently taking when buying into BTC. There is quite a bit of net unrealized profit, and again, some people might take that profit. We are not yet in euphoria greed zone. We are not in capitulation territory. We are somewhat balanced, and so should be the allocation to Bitcoin in a portfolio right now. It shouldn't be crazy high. It shouldn't be super low. The typical allocation, I believe, makes most sense right now. Now, there's the approach to simply just buy into Bitcoin long term, right? To buy, say, once a month to dollar cost average in, say $1,000 every month. And that is a winning strategy because there is a lot of volatility, and the more volatile an asset is, the better it is suited for regular purchases. And had I done this, I would have gotten this light gray return. Instead, I outperformed just dollar cost averaging into Bitcoin. I got this black line in return. The Bitcoin maximalists say that we should forget about all of the altcoins and that Bitcoin outperforms the altcoins most of the time. Everything goes down against Bitcoin long term. So in the end, just stick with Bitcoin. That's what the maximalists say. But I think it's better to actually take advantage of this market asymmetry. Because while the Bitcoin maxis are right that most altcoins underperform Bitcoin most of the time and that trying to find the next 10 or 100x meme coin is a losing battle long term, while this is true, we can still take advantage of that underperformance. The altcoins tend to do so poorly because of supply expansion. So users of the platform of the altcoin, or maybe the early investors in the token, or maybe the team, they get token unlocks. They get more and more tokens available over time, and they might dump those tokens on the market, depressing the price. For example, here, this is the circulating supply of the balancer token. It's a very typical DeFi token. We see this typically across the entire altcoin market. And if the supply grows faster than the demand, of course the price has to come down, at least relatively speaking. And so this is then the balancer price relative to Ethereum. It just goes down all the time. And we can flip this. We can take advantage of this. If we go long Ethereum and short balancer, or if we take out a loan in balancer, swap this into Ethereum, we get this return here. And that's how I made this outperformance over buying and holding Bitcoin. I shorted poor altcoins and went long Bitcoin, Ethereum, and Solana. And in this video, I actually want to share this for free over here. How can we get this kind of return? How did I achieve this kind of return in the past? There are several approaches, and I'm sharing now the one that I'm using for several years already. Go to the platform Aave. So that's aave.com and open the app. Over here, you can borrow several tokens. So you're providing some kind of collateral. It's a borrowing and lending platform. You provide collateral and then you can borrow against that collateral. And what you want to borrow is the balancer token, right? That's a token that tends to go down versus Ethereum all the time. Thus, if we borrow balancer, if you've got a loan in balancer, and we then swap that balancer versus Ethereum, and then we wait for balancer to continue to go down versus Ethereum, we suddenly have profit, right? Our loan, our debt is going down in value. Our asset is going up, relatively speaking. And then once we want to lock in our profit, we just pay back the loan with the appreciated asset. It doesn't cost much at all to borrow balancer. It's 0.31% per annum. Yet the price is going down so consistently. I made tutorial videos to the premium members about this strategy in detail in the past. And again, it was a very nice moneymaker. This is why people stay subscribed to premium, because the membership basically pays for itself if you've got some capital. But I found an approach that's even better, and that's currently my focus. I started this out 2.5 months ago. It's again relative valuation bets, but it's not with borrowing and lending platforms. It's instead with perpetual futures. I started with 40K, and then after 2.5 months, this turned into 60K, so 50% return. I don't expect that the growth rate will be that strong going forward, but still, I do think that in general, this is a winning strategy, right? Simply because the insiders, etc., they cash out over time long term and depress the price. The problem with perpetual futures is that we need to be very diligent around our risk management. We have to use very tight stop losses, and we then have to adjust those stop losses regularly. We have to find the asset that's most deflationary, that might have seen a short squeeze, etc. And while I'm sharing all the trades that I personally do, many people don't have the time to copy trade. And so I got asked regularly by the members, can't you just provide some kind of liquidity pool? We provide money to that pool and then you trade for us. And I finally started this just 2 days ago. It does not use Aave. It does not use borrowing and lending platforms. Instead, it uses Hyperliquid. And this is a tutorial video on how to use the Bitcoin strategy copy trading vault on Hyperliquid. So that's this platform over here. The platform is growing massively. So in less than a year, it attracted almost 2 billion worth of value. And I've created a vault, so a capital pool where the annual members of Bitcoin strategy can deposit to and then simply get the same kinds of return. If you're just starting out and you've got some time and you don't have that much capital yet, then you can do this all manually, right? You can just go through the tutorials, you can watch them and then learn how to do this all yourself. I am sharing my own trades as well. And there are plenty of people that do this very successfully in the community. So if your crypto portfolio isn't yet $5,000 or $10,000, it's below that, then it makes sense to just go with the monthly membership and do the trading yourself. But if you don't have time, if you've maybe got a business to run and you've got way larger amounts to deal with, you don't want to hassle with all the risk management, etc., then the annual membership is for you. Because for the annual membership, where by the way, you're also saving a bit of money, you get access to the copy trading vault as well, with all the instructions on how to actually deposit your funds. And while I cannot guarantee that we make another 50% in the next 2.5 months, I will do my best to achieve positive returns. This strategy has outperformed buying and holding Bitcoin for more than 4 years now. And I don't see any reason why it shouldn't do the same using perpetual futures instead of borrowing and lending platforms that we used in the past. A link to Premium should pop up directly over here on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers.